Hello everyone, this is Bella. Welcome to my new technology analysis teaching video. Today we will learn some simple content, which is the main signal of MACD index, corresponding to price behavior. A lot of novice traders go through a phase where they believe that indicators are king, only operate according to the signals given by the indicators. After a period of time, it is found that the technical indicators have hysteria. If you follow them, you will fall into the other extreme, that is, you think the indicators are useless and then delete all the indicator templates and start to learn naked K. All technical indicators and price behavior should complement each other, and each technical indicator signal should have a corresponding price behavior. It should be very easy to understand most of the indicators after studying the price behavior course. I hope that today's video course will give you a new perspective on the price movement to reach the state of understanding as soon as possible. Let's talk a little bit about the MACD algorithm. I'm also impressed that many of my new friends don't even know how to calculate the index, and they dare to trade their own real money. I think if you're going to use an indicator to trade, you have to figure out how it works, and it's designed to represent what the market is so that you can decide how to use it to support your trading plan. I'm just going to talk a little bit about the MACD index here. If you look at this black line in our graph, which has been bolded so you can see it clearly, this black line is usually called the express line. It's actually the MACD line. So how did he figure it out? So if we look at the two moving averages in the main chart, they are EMA 12 and EMA 26, and the parameter settings for the moving averages are shown here. So 12 and 26 are our default parameters for MACD, and you can see here that's the default parameters, and MACD line, it represents the difference between these two EMA moving averages of 12 and 26. MACD means the convergence and dispersion of moving averages, so when MACD line is the black line above the zero axis, it represents EMA 12 above the EMA 26. The further away the black line is from the zero axis, it represents EMA 12. The further away we are from EMA 26, we can see it by the rise of the MACD line in the front of the graph, and if you compare it to the moving average above. What about the back section? Look at it here. What about the back section EMA 12? So the MACD line is below the zero axis, which means that EMA 12 minus EMA 26, which is a negative value. So if one EMA 12 coincides with EMA 26, which means that the difference between them is zero, then MACD line, it's going to be here at zero. So that's easy to understand, and if you look at the red line, this is what we call the slow line, and he just worked out how to passivate the fast line you can go through the literature, and it's a little tricky to talk about, and the difference between the fast line and the slow line is the MACD bar down here, which is what we call the energy bar when the fast line is moving away from the slow line. So the difference between the black line and the red line on the graph is increasing, and the difference between the black line and the red line is increasing, and the energy column is getting stronger and stronger, and the energy column is getting darker and darker, and as the fast line approaches the slow line, which is the black line on the way, and as you approach the red line, the energy column gets weaker and weaker, and the color of the molarity of these indices along the way gets lighter and lighter. The MACD algorithm is just like that, and it's pretty simple to understand when you sort it out. And then we're going to look at the price behavior of the common indicator signals of MACD, and what about the examples that we've chosen, and it's mostly successful, because what we're going to focus on in this video is the price pattern of the indicator rather than the specific use of the indicator. We saw earlier in the price behavior course that all forms are likely to fail, and the same goes for technical indicator signals. The first MACD indicator, signal gold dead cross. This is the most commonly used MACD indicator signal, and its definition is very simple. It's fast line up through slow line, it's gold cross, fast line down through slow line, it's dead cross. But really, while a lot of people are keen to read the MACD dead cross signal, but I think this signal is basically useless without any reference value. This is a typical recovery God index, trading on the white blind signal case. MACD gold dead fork has these common situations: the high gold fork on the zero axis above the zero axis above the high dead fork on the zero axis close to the zero axis, and then upward gold fork under the zero axis, low dead fork under the zero axis close to the zero axis, and then a pure dead fork. these 6 cases in the high gold fork and the low dead fork, it has no reference at all, so I'm not going to talk about it. Let's look at the second case, which is the high dead fork and the low gold fork. Here are 2 examples of high dead crosses, here and here. Now we know that the MACD line is this black line that represents the difference between EMA12 and EMA26. MACD is now going up, which means that the difference between these 2 moving averages is increasing, which means that the momentum of the trend is increasing. The MACD line is going down, which means that the difference between these 2 moving averages is narrowing, which means that the momentum of the trend is weakening. And we all know that a common trend pattern is a trend movement followed by a correction, and then the trend movement continues there. The current MACD index is the trend movement, which means that the momentum is strengthening, that is, the MACD line is away from the zero axis, while the correction movement is the trend momentum is weakening. The MACD line is returning to the zero axis, and the trend momentum is continuing after the adjustment, and the trend momentum is getting stronger again, which means the MACD line is returning to the zero axis and then away from the zero axis. Let's look at the 2 high crosses in the chart below. It's very simple. It's confirmation of the pullback movement. The MACD line is going from high to zero, but it has no reference value. Because by the time the high crosses form, the pullback movement has already gone several K lines. The MACD line is this black line, it's already turned this dead fork, it has a very strong lag, and in this case, in our diagram, you take it just this high dead fork signal and you use it to flatten out your multiple orders as a basis. It's not bad, but you should never use it for a backhand short. The first gold fork is the same reason there is no reference value, it is too serious lag. Now if we look at the dead cross below zero, which is not a very standard case, because the MACD line has already crossed up through zero, in the usage of MACD, this is a sign that the short trend at this level has gone wrong and we should look at the larger cycle. But we focus on this dead cross. The previous market conditions had MACD moving down away from the zero axis, and the corresponding price behavior was the initiation of short energy. We saw this period of decline, which was very strong, and then MACD returning to the zero axis. What about the K line? It's the movement of a pullback with a dead cross near the zero axis, and that can be interpreted as a continuation of short energy, but what's the problem with that? Or is the lag too strong to operate according to this signal? Let's focus on the red arrow pointing to the K line. Why is MACD is a recovery God indicator is a representative of the blind trading? One of the reasons is that it's very visually misleading, and if you're not like me when you rewind, you just put this dead cross K line and you mark it and you see at first glance, oh, this is dead cross and the price is here, and you think that's not a bad entry position, so where is it actually dead cross? It happens after the K line that I've marked with this arrow closes its MACD signal, gives a dead cross, and this is easy to find. We just watch this energy bar change from green to red. It's easy because the green energy bar, it represents the MACD line, and this slow line, and this black line, and this red line, and the difference is positive, and then its energy bar is green. So when the black line is the MACD line below the slow line, the difference is negative and it becomes red, so you look directly at the red and green of the energy bar, and you can see the change between the gold and the dead cross. So the red arrow on the way points to the close of the K line and the energy bar changes from green to red. The MACD is giving the death cross signal, and it's lagging so much that if you look at the K line close and you go short, it's definitely not going to happen if you're going to participate in the continuation of the short energy earlier than the death cross based on other price behavior or other signals. Let's look at the case of the gold fork near the zero axis. In this case, the lag of the gold fork is not too serious, but most of the time, it has a strong lag. Friends who like to watch the MACD gold fork can be like me. So to sum up, the metal difference of MACD is really not much reference value, such a serious lag. Many signals are better than this. The second commonly used signal of MACD is a fixed axis rebound. Some people call this top-down return to zero axis a rebound, this bottom-up return to zero axis a retraction, and I'm not going to break down the terms, but the point is, what does it represent in terms of price behavior? And the answer to that question we've already answered before. Because one of the common rules of price movement is trend retracement, trend continuation, and the MACD line, which is the difference between these two moving averages, and it represents the energy of the trend movement. So the MACD line has a corresponding rule that it's moving away from the zero axis back to the zero axis and away from the zero axis again. So the MACD returns to zero movement. It's a retracement pattern in price, and the scale rally is the end of a trend and since returns to zero movement. It's a retracement movement, and as we talked about in price behavior teaching, there are a lot of returns to zero patterns in the market, so the entry of a returns to zero rally is not a fixed entry. This is a returns to zero rally case. If you look roughly at the big bands of these two arrows that I've drawn, this is a simple case of a pullback that we've studied, but this pullback, if you look at it carefully, it has too much overlap between the K line and the long shadow line. And the K line, even though it's an outsource positive line, it doesn't look very good with long up and down lines, so the price behavior that we've learned about this pullback shouldn't be involved. But if you look at the MACD line is coming back from the high to near the zero axis, and then it's going down and the energy bar is weakening, which means that the energy bar, from this dark close at the shot to a light close, then it would represent a pullback that could end with the bull momentum returning and provide a clear entry signal for the rally, and sometimes the indicator signal, as in this case, does help us filter out the noise on the K chart, and that's a matter of opinion. This is also a relatively simple case of fixed flow rebound, and its corresponding price behavior is relatively simple. It can enter the market according to the K-line form we have learned. Here, I will focus on the setting of the moving average parameter used to match the scale rebound. These two numbers are Fibonacci number accidents that are set arbitrarily by custom, and there's nothing magical about it as long as it's between EMA 30 and 60, and depending on what you do you might have to make a little tweak between those two numbers, between 30 and 60, but because I'm a price action trader, K-line is the main indicator just for reference, so I just set it up. When the MACD line returns to the zero axis, the corresponding K line always returns to EMA between 30 and 60. This is a rule summarized in practical operation. As for the logic behind it, I haven't studied it much. A lot of people have a misunderstanding about the trend of the callback is to think that the callback must be a big contrarian band. This idea is actually wrong. Callback form, more accurately said, should be collated form. Horizontal interval is also a kind of overall form. It also count as a callback. Some of my friends, for example, see a trend that is overdone or that is out of momentum and they think that the market has to go through a big countertrend pullback before they are committed to the contrarian trade, and then what the market is likely to do is a lateral range adjustment range and then a subsequent breakout. And if you don't change your mind and you're waiting for that big wave to come out, and you're going to lose a lot of money. The case in the figure is the horizontal interval adjustment of prices. The MACD line slowly returns to the zero axis, and then the trend energy continues. Here is the weekly rebound of the MACD line to zero, and the K line is the continuation of the trend after adjustment. This is also a case of the adjustment of the horizontal interval to the rebound. The price behavior corresponding to the returning to zero weekly rally of MACD is the correction movement. For those of you who like to do MACD, you can combine the correction patterns that we have learned and try to understand the more cases. I won't explain them again. It's really not worth the characteristics of a pullback pattern that you can apply to the MACD returns axis rally is that A, the pullback pattern is complex and not uniform, and B, the pullback pattern can fail to evolve into intervals or reversals, and that's also useful for indicator signals. Finally, we'll talk about a common MACD signal, which is also a very useful signal, which is divergence, but we shouldn't omit this indicator signal just because it works. Later, we'll look at the effectiveness of this signal in conjunction with price behavior. Let's talk about the definition of MACD divergence. I thought this was a very simple common sense, but the reality is that many people are unable to grasp the correct divergence signals and have been trading in the wrong way, which shocked me very much. The commonly used MACD divergence signals are divided into MACD line divergence and energy column divergence. No matter what kind of divergence you look at, a big premise is the MACD line. This black line, it can't cross the zero axis, and this is very important, but a lot of people don't know that. If you look at this example in the chart below, whether it's AB2 or BC or AC, they're diverging and they're showing that the low of the price is going down but the low of the MACD line is going up. Let's say that the MACD line represents the kinetic energy, and that's the divergence between the price and the kinetic energy, that the trend energy may not be enough. The MACD line in this case doesn't go up the zero axis, and if the MACD line in this case goes up the zero axis a lot and then it diverges from the zero axis, then the effectiveness of the deviation signal will be greatly reduced. Some of you might be wondering if there are deviations across the zero axis that are also valid. We do technical analysis and we talk about the probability that when the zero axis is crossed by a large amount and the deviation occurs again, the success rate of the signal is greatly reduced. There are some signals that still work well, but do we really need to do that for a signal that already has a very low success rate? So it would be easier to do that if we just look at the deviation where zero axis is not traversed. If you want to use MACD, well, it is very important to understand the market cycle. Assuming that the current level of zero axis is traversed, then you have to look for the signal pattern in the larger time cycle. The price behavior corresponding to divergence is very simple, and we already know from the definition of divergence that it is a lack of energy in the price movement. Moving on to the case that we just showed, and I've labeled each downward push, and you can see that each downward push is decreasing in turn, and the comparison of the last two paragraphs may not be very clear, but if you can actually measure it, that's the conclusion, and these three words in turn push it down and form a three-push wedge or a channel that we've learned about price patterns. If we look at the familiar case of the triple push of the Bitcoin daily line, then this is a continuous divergence, as in the previous case, the first 2 points or the 2 points of 2, 3, 2 or 13 are all divergence. So what it represents is the lack of energy in the trend, and we've talked about this case many times in the price behavior course, the case of the Bitcoin event, and we're going to look at it again today in combination with the indicators, and it's going to be the same thing. Just to talk a little bit about the entry of divergence, a lot of newbie, and it's going to be pretty awesome when he's first introduced to divergence. When you see a divergence signal on a reorder, it looks like you can sell at the top and buy at the bottom, but if you take a look at the K lines where the divergence occurs, you know that's not the case at all, like the 2K lines that I've indicated with the arrows when the 2K lines close. So let's look at the indicator, and I've marked it with this vertical line, and the one on the left of the vertical line is the closing point, and the same thing here is this arrow, and the K line closes, and when these two K lines close, the indicator gives the signal that the energy bar is getting lighter. That's when we know that divergence is happening, and we're thinking about going in instead of at this peak when the K line in the back is confiscated, and we know that the price is diverging, and that's not how it works. That's not how it works at all. This K line is just these two K lines, it's just the beginning of the weakening of the energy bar, and if you're watching the MACD line deviate, you're watching as long as the black line deviates, it's going to have to wait a few more K lines behind this K line after the arrow, after the K line, until the MACD line turns, and then they're going to come in. So he's even later. So the divergence signal is not as strong as a lot of people feel at the time of the resumption, and you're actually using the price behavior to enter like the two signals, the K line, and you're entering at the same position. And if you look at this case, there is an indicator divergence signal, which is the low in the price is going down, but the low in the MACD line is not going down. So what the price does is that the push in the second segment is weaker than the push in the first segment, but it just represents a decline in the power of the trend, and a lot of people who are first exposed to divergence get very excited. They feel like they can take advantage of the reversal of the trend and make a lot of money. It's true that a lot of trend reversals have this kind of divergence signal, because most reversals are caused by a lack of trend energy, but does the tendency to deviate easily mean that the tendency to deviate is prone to trend reversals? This logic obviously doesn't hold up, and if you think about it a little bit, it's a misconception, and we've already seen in the price behavior course what happens when the trend energy is insufficient. It can lead to a deep pullback or a sideways trading range, and ultimately it can lead to a trend reversal. And when you understand the nature of the price movement, you don't trust that divergence indicator, or you don't trust any indicator signal. Another example of a divergence is this one. It's also a divergence, which is the low point of the price. It's basically parallel, but the MACD energy is clearly not keeping up with it, and that's also a sign of a lack of trend energy. But in this case, if you use the indicator, obviously you can't participate, because when the indicator gives the signal, that's when the arrow closes the positive line. This rally has largely run its course. If you use price behavior here, it has an entrance pattern, but the entrance signal is difficult to grasp and the logic is complicated, so I'm not going to talk about it in the course. When you get a good handle on the price behavior, you don't have to look at the divergence of the indicator, for example. In this case, there's a sharp decline in the front and then he adds a dip in the channel, and now there's a reversal of the K line after breaking the front low, and that must correspond to a divergence signal in the small period. Now this is a 4-hour graph, and we're going to switch to the 2-hour graph, which is the same graph that we had before, and you can see the divergence very clearly here. After this K line, which is the last K line, the energy bar has weakened and the divergence of the energy bar has occurred, which is not shown here. If after a few K lines, the MACD line, which is the black line, follows the head, then the divergence of the MACD line is valid. And there are a lot of cases like this where if you can read the energy change directly from the K line, you don't have to look at the metrics, and of course there's no problem if you use metrics before you're really good at it. And I used metrics to get there. If the MACD line moves away from the zero axis, and then it goes sideways like this, and it doesn't come back to the zero axis, then its price pattern is this fast and fast. If the MACD line sticks to the zero axis and twists and turns around the zero axis, its price behavior is a narrow trading band. If it swings around the zero axis, its price behavior is a wide trading band. Philosophical forms are a little tricky to find, so I'm not going to look for Amway. And these forms are much easier and more efficient for you to trade in price behavior, and you don't have any advantage in using indicator signals. And finally, a little rule of thumb: the MACD indicator signal is not particularly effective in the stock market, but it is very useful in the B circle of the stock market. You can see that the cases I use are all digital currencies. I am not sure why this is so. So these are the price behaviors associated with the common MACD signals, and in general MACD and price behavior fit reasonably well for a lot of price patterns that few other indicators do. I used MACD index as an aid when I was making profits in trading, and then gradually got rid of the index as I understood the price behavior more deeply. Therefore, novice friends can also learn MACD, even if they do not have to trade. They can also gain a new angle to understand the market and do not believe in indicators. It's true that some traders do a good job with the indicator system, but it's not because the indicator is awesome, it's because the collagen level is excellent, and there's no need to dismiss the indicator as useless. As long as it's used properly, it can make our trading much easier. Okay, that's all for today's video. Thank you all for watching. Please consider like, comment, and subscribe. Also don't forget to follow us so you watch the following updates as fast as the video upload. Bye.